Okay, hello, Callum here. I'm going to take you through the weekly chart storm. And if you wanted a text version instead, there's a link here. Put a bit of a commentary up on Seeking Alpha there as well. So let's just get right into it. Starting off with the Fear and Greed Index. This is put together by CNN Money. Combines a range of different indicators and shows, well, things are pretty greedy at the moment. Well, certainly there's a lack of fear at the moment, and you know, when I look at sentiment indicators, I always think, there's two things you look for. One is when it gets to an extreme, and the other is when it gets to an extreme and rolls over. Hasn't rolled over yet. Just at the moment, really shows that the momentum is strong. And on a very similar note, onto the second one. This one shows the probability of increase in stock market in next year. Basically, the proportion of consumers surveyed that think that stocks are going to go up over the next 12 months. And you can see there that it's at very familiar levels. Got to these levels at the peak in July 2007 and at the sort of smaller peak prior to the dual corrections in 2015-2016. So, it's a sign that you see near a top, but you look at this period here prior to the top in 2007. It's quite choppy, but relatively elevated throughout that period, and that just goes to the point that it's often easier to pick a bottom than a top. Now, speaking of other things that you see at the top, here is US high yield credit spreads and the VIX looking very low, and I've got here a little remark that I've said, a sign of well-placed confidence or misguided complacency. And one comment that I got in regards to this tweet was yes, and I kind of agree with that. Very much in line with what I just said. You can see during that 05 to 07 period, both VIX and high yield credit spreads remained relatively low. A couple of little episodes along the way, but the market can stay complacent for an extended period of time. So you have to sort of line it up with all the other things. And one thing that would say well-placed confidence would be perhaps this one. It shows the spread between S&P 500 earnings yield and investment grade credit yield. You can see that there's still a substantial gap, which tends to be a supportive thing. When you look at this chart, you say that there's relative value still there, despite the very high levels of absolute valuations. On to the next one, number 5. This chart here is a bit of a schematic showing, based on the way that these exchange traded products work, the degree of what you might call forced VIX futures buying would happen at various different levels of one-day S&P 500 returns. So, for example, if the market was down 5% in a day, that would force or drive, drop buying of about 400,000 contracts of the VIX. So, the way that I'd interpret this would be that, it's created a situation where, should we get a sharp correction, it'll drive a potentially higher spike in the VIX. So, whether you call that an increase in market fragility, maybe you do. And on the topic of the VIX, good segue here into this one. It shows 5 different models that I've got here on the VIX, and these span from intermarket high yield credit realized and to sort of more fundamentals in terms of claims, PMI. And they all say that the VIX, except for the policy uncertainty one, they all say that it should be sort of lower because then the fundamentals are realized they're all looking actually fairly fine at the moment. But even then, currently all of the VIX is much lower than those models suggest. I guess one thing to add there would be that, were these indicators to start to turn and the VIX to remain low, that would be something to be starting to, factor in a major wave versus this sort of minor deviation, but still, VIX looks objectively low, almost too low there. Number 7, this is a bit of a lay of the land for the buy, sell ratings. These are aggregated across the various sectors, which is quite interesting. I mean, one thing I'd note there is that there's very little sells, and, quite chunky amount of holds. I think it's well understood that, that there's typically much more holds and buys than sells. And you might try to argue that that's because, over the long term markets go up, so there's, it's a bigger call to put a sell recommendation on. But, there's a variety of reasons, including reputation and conflicts of interest or potential. But anyway, looking at the sort of way things are positioned, at an aggregate level, you can see there that 50% of the ratings are buys. So I guess in that respect, there's room to move to the upside. And across the sectors, there's infotech, energy, healthcare at the more popular ones, utilities, telecoms at the other end. And this here one, the black line shows the movement of sell side consensus across time. So this is basically how these ratings are evolving across time. It's quite an interesting indicator how it's moved. There's sort of this structurally higher or structural bullishness around the 2000s period, and then this prolonged period of bearishness post-financial crisis. One thing that I did note there, if you look at the level that it got to in 1987, we're kind of at similar levels there. So it's kind of one thing to note in passing. Onto a couple of sort of interesting charts here. This one, really cool chart from Ed Clissold. So this is a chart of the median effective tax rate across time for the S&P 500. Now, when you're thinking about the prospect of tax reform, tax cuts, I think this one's quite informative. We've already moved from about 45% down to 27%, which has been a substantial reduction. Now, I'm sure that a certain element of that is probably due to, increasingly resourceful or creative tax accountants, restructuring their organizations to be, tax efficient. But, there has been tax cuts throughout that period. So I guess my point on this is, how much further can it go when it's already, the effective tax rate's already down at 27%. Who knows, maybe we've seen zero interest rate policy, maybe someday we'll get zero tax policy. Wouldn't hold my breath for that, but certainly food for thought in that one. And another food for thought one is this one. And it's probably worth reading the article to get a little bit more context on this one, but this one looked at companies where the CEO was sitting on other boards, which, I don't know, to me that kind of sounds like a kind of a strange concept. Not sure why they might do that. I mean, you could probably argue that there's some benefits to that, but it seems quite logical that it would split their focus. And what the research in that article found was that the CEOs that serve on multiple boards earn more money, but their shareholders don't necessarily earn more money. So I guess on a governance perspective, that's one to add to the to the list of growing body of research on the governance side of things. Governance is an increasingly important factor, and I think well, deservedly so. It's one of those ESG factors that is was once a little bit alternative and now is becoming very much mainstream as it's shown to become something that's helping returns. So look, I'm going to leave it there, and as I said, the write-up over on Seeking Alpha, I'm going to put a link to that in the video here. And if you've got any comments or questions, please go ahead and leave them in the comment section of the YouTube video. Go ahead, subscribe to the channel if you like what you heard. I'll be putting out another video later in the week, something macro, something multi-markets. So stay tuned for that.